John, thank you very much. Good morning, everyone, and thanks to John and Linda for inviting us to participate. This is actually the third lead marketing conference that Profitero has participated in, and I know it's going to be another great day. Just briefly to introduce Profitero and myself, we're an e-commerce analytics provider that works with both leading retailers and brands to optimize e-commerce channel performance. And my role with the company is the head of product strategy and our analyst team that supports customers. Over many years, I've worked with leading CPG companies to establish an e-commerce strategy, an organization that can support growth in the channel, and a capability model to drive performance. And considering where we are in the year, I realize that many of you are likely in the middle of or perhaps even towards the end of your annual planning process. And so while I don't think we can answer all of your questions in the context of annual planning in this brief session, I did want to give you some perspective about where we think the industry is headed and some things that if you haven't already baked into next year's plan, you may want to think about pretty quickly here. So let me just set up what we're going to cover. First, I think most CPG companies are at least aware of the incredible growth that the online channel represents from a volume perspective and the disproportionate influence that it has over even offline retail. But I just want to share some insight on that topic and then give you a roadmap for how you can plan to represent your brand favorably in the channel over the next year and beyond. And build an organization and toolkit that I think is really essential to outperform. So I just briefly want to share a simple framework that I think might be helpful as you contextualize where you sit versus your competitors and the industry at large. And when we're just getting to know a new CPG company, we typically interview them and do some diagnostics to understand the state of readiness inside that organization to not only participate in the online channel, but really win and outperform. And that often starts with building a case for internal support, because while in many companies, e-commerce is a dedicated specialist function, there's no question that it impacts all disciplines and teams within the organization, especially shopper marketing, especially shopper insights, and absolutely the account teams. So one of the very first steps is building awareness and support among senior executives and those that may not be directly commercially responsible for e-commerce, but that do have influence over resource allocation and strategic direction. And so assuming that you've got broad-based awareness and support, you need to define a picture of success. What is success in the channel? Is it purely anchored in volume and profitable sales growth, or are there other metrics related to how the brand is presented and protecting or even building equity in the channel? And that very often leads you to decisions about where to play. That is, which retailers should we focus on and how to win. And so if you haven't already been through an exercise to define that picture of success and architect a strategy, it's one of the very first steps. And assuming that you've got support and you know where you're headed, you need the team and the toolkit to get there. And I would tell you that in our observation, we haven't done a detailed study, but we work with more than a dozen big CPG brands globally, and we encounter many others. I think around 20% of the industry is what we would consider advanced on most of these dimensions. That is, they have broad-based executive-level support for e-commerce. They have very clearly defined KPIs and a clear strategy, which is ever-evolving, but at least has been documented and communicated. They have dedicated resources for e-commerce in the form of both people and tools to help drive performance. And so it's a minority of the industry, but there is a cohort that's far ahead. I would say that 2/3 of the industry are progressing. They may not have checked all these boxes. There's a lot in flux, but they've at least made a stated commitment to success in the channel, and they're doing something. And then there's probably about 10% of the industry at this point that is really just getting started. So I want to go into a little more detail in our session today and tell you what I think each of these stages sort of means and how you can make progress faster than you might have expected. Many of you may have seen the study that was released by IRI and the Boston Consulting Group last year, but I think it's just a profound reminder of the explosive growth in the e-commerce channel. That study that was done in partnership with the GMA projects that within 5 years, 5% of e-commerce, of CPG sales will be in the online channel, with the potential for as much as 10% to be sold very shortly thereafter. And that's a pretty rapid growth trajectory, but I think it's plausible given the exponential growth of e-commerce. That is, even though most retail is still done offline, there are millennial households that are entering their high consumption life stage, and as their households grow, are already spending disproportionately online. And so this is not a slow and steady linear growth curve. And when you unpack that projection, it represents half, potentially even more than half, of the growth in the total CPG industry coming from this channel. And what I haven't even depicted here is the complementary influence that the digital shelf has over offline retail. There's new data from Deloitte just released last month that estimates that by the end of 2015, 2/3 of all brick and mortar retail will be influenced by digital. And I think the number for grocery and CPG products is a bit below that, but there's no question that above and beyond the volume that is building in the online channel, there's incredible influence that product pages and mobile apps are having over in-store decisions. So there's growing consensus among leading CPG companies that this is a channel that can't be ignored from both a commercial and a marketing perspective. But there are some fundamental challenges of e-commerce, as is often the case with emerging distribution channels. Certainly there's been a lack of data, and that's one of the things that our firm is really focused on impacting. But there are many metrics that we use to manage our business in the brick and mortar retail channel that are simply unavailable for the most part in the online channel, despite all this promise of better measurability. So as the channel's importance grows and budgets and resources grow, it's been harder and harder to keep track of how you're performing and make informed decisions about where to invest. There are also some challenging economics, and that's not to say that you can't grow profitably in the channel, but just think about the challenges of making money, both as a retailer and a supplier, when shipping costs $6 or $7, and the price point of one of your SKUs might be $4 or $5. The pace of change is another critical challenge. It seems like every month there's a new venture-backed retailer in the space. There's a new device that has implications for how you connect with shoppers, and there's a new solution provider that wants a chunk of your budget. And so new capabilities are tough to keep track of and keep up with. And so the pace of change is one of the greatest challenges to companies in this space. So let me just walk you through these 5 simple steps to gaining widespread support and advancing from a stage where you're just beginning to focus on e-commerce to a stage where you're really progressing quickly and potentially even getting to the head of the pack. You know, I think you always have to start with defining success. And as I looked at today's attendees, I see a lot of diversity in terms of roles and responsibility. And I think where you sit inside of your organization will largely dictate how you view success in this channel. I think there is a bias in many CPG companies initially to focus on some of these harder objectives like incremental sales and a year-over-year growth number, typically outpacing total category growth, so that you're getting your fair share or disproportionate share of this emerging channel. And to a lesser extent, at least while the channel is still maturing, profit. That's not to say you should ignore profit, but I think it's reasonable, given the pace of growth and some of the evolution of the channel, to have a slightly more flexible view towards profitability while you're trying to establish a foothold. And then if you're more oriented towards marketing and brand initiatives and objectives, you may be focused on your brand equity, meaning the brand's presentation in the channel and some of the storytelling around the brand and representing the brand in the best possible light. You may also care more about how online influences offline. And so this is in support of some of your brick and mortar retailers who are investing in the online channel. There's also immense potential, as I'll detail in just a minute, around brand advocacy in the online channel. Social media is a focus for so many CPG companies and marketers, but often overlooked is the importance of ratings and reviews, which are disproportionately influential. We see data almost every month that supports the notion that shoppers trust their peers, especially peers who have experience with a brand or a product, above almost any other source of information. And if you engage with shoppers the right way, you can really disproportionately impact your brand through engaging some of your loyal shoppers to go leave reviews on retailer sites. And I just want to emphasize that when you're defining these success metrics, it's really important not only to think about the upside potential and all this opportunity for potentially incremental growth, but also the risk of doing nothing. And I've taken a screenshot here of one of our Amazon Fast Movers reports, which are free reports that we publish monthly for more than 10 categories at Amazon that identify best-selling products in these categories and benchmark characteristics like the number of images and ratings and reviews. And what you'll notice almost invariably, regardless of the category, is that some of the fastest moving brands and products in this online channel are emerging brands. They're not the incumbent market leaders from the brick and mortar channel. They are brands that are not necessarily in widespread brick and mortar distribution and have nothing to lose by investing all in the e-commerce channel. And so as they invest aggressively online, they are often establishing a foothold that gives them a really compelling growth story that they can then take to brick and mortar retail, leverage their track record of success online, and start to displace incumbent market leaders in the brick and mortar channel. So I always encourage folks, as they're building a case for support, absolutely try to estimate the size of the prize, understand how you compare to your direct established competitors, but don't lose track of the possibility that there are new entrants that are on offense in this channel. Assuming you've got a clear picture of success, you are going to have to prioritize. I don't think I've ever encountered a manufacturer that has infinite resources in terms of people or budget, and so you're going to have to decide where to play. And I think for most CPG companies, particularly those that have shelf-stable products, Amazon is a non-negotiable. We estimate Amazon's share of the total online market as somewhere between a third and 40% of the total market, and that varies, of course, by category. But Amazon has made an increasing investment in the CPG category with a growing portfolio of effectively formats, not only Amazon.com, but also their Prime Pantry program, which is almost exclusively oriented to CPG products and launched last year, as well as Amazon Fresh, which sells temperature-sensitive products in more than 5 U.S. metro markets and is expanding internationally at this point. They've also invested in hardware like the Dash Wand and the Dash Button, which is oriented to CPG products, and their Prime Now same-day delivery service is another way to deliver convenience for everyday essentials. So given their prominent position in the market, you simply can't ignore Amazon. But there are other important new entrants. Jet is a retailer that we followed closely and published a lot on. And while their business model is evolving and there's no certainty that they'll be around in 24 months, they are certainly a scale-based play that is disrupting the market in many ways with a huge focus on price transparency. And so whether or not you decide to go directly into business with Jet, I think they're another one that you have to at least be aware of and pay attention to, because it has huge implications for the channel overall and for your brand. And then, of course, are the brick-and-mortar retailers who are increasingly investing in e-commerce, often with their own unique models that are a little distinct from the pure players like Amazon and Jet. So Walmart has made an increasing investment not only in local delivery but in click and collect, and grocery is a critical part of their business. You also have retailers like Target and many other brick-and-mortar retailers that are partnering with a third party like Instacart, which, if you're unaware, is potentially the fastest growing online grocery model in the U.S. While it's not a retailer directly, they now operate in more than 15 U.S. metros with more than a dozen brick-and-mortar grocery partners. And they've made the online grocery model accessible to more households and more metro areas in a shorter window of time than any other retailer. So they've really impacted the market over a short time horizon. And then, of course, you've got retailers like Peapod, who is the oldest continuously operating online grocer in the U.S., and now Kroger, through the acquisition of Harris Teeter, as well as Vitacost, making increasing investments in the channel as well. And it's important to understand that there are not only distinct motivations for dealing with brick-and-mortar retailers versus pure players, but also different engagement models. That is, the importance of e-commerce to each of these brick-and-mortar retailers is increasing, but it's unlikely to be the number one priority for their businesses. So it's essential that you have a deep understanding of where e-commerce fits in their total go-to-market strategy, and that you leverage their brick-and-mortar assets and align your joint business planning efforts with their total business, respecting that brick-and-mortar is still the priority. And it's also important to understand that particularly on the supply chain and logistics side, the fulfillment models or the distribution models for a lot of brick-and-mortar retailers are really distinct from the models of an Amazon.com or a Jet. These are often orders that are picked and delivered or picked up from brick-and-mortar inventory. And so you really need to make sure that your forecasting and replenishment is closely aligned with your core brick-and-mortar teams.
Okay, Keith, before you continue, a question has come up in the chat box. You may have answered it partially. The question is, how is dealing with retailers like Walmart and Peapod different from dealing with an Amazon?
Yeah, it's a great question, and to build on my previous comment, I would tell you that while it's difficult to generalize, I think that most brick-and-mortar retailers have an established framework for collaborating and partnering with their vendors. And the discipline of category management and joint business planning is really well established with most of those trading relationships. And in the pure play online channel, it's best thought of as a platform as opposed to a partnership. That is, if you bring shopper insights and a plan for innovation to your typical online pure play retailer, they're likely to smile and nod their head, but unlikely to act on a lot of your input. But there's immense opportunity, in my opinion, with the Peapods and the Walmarts of the world to experiment and innovate and to collaborate to support your mutual shoppers with some joint business planning initiatives. So you definitely want to understand some of the distinctions in the shopper's dynamic. You definitely want to understand the supply chain distinctions, but generally speaking, I think there's a greater opportunity for partnership when you're dealing with brick-and-mortar retailers.
Okay.
So I can't tell you everything you need to know about building a world-class team, but I do want to just share with you some quick thoughts on two profiles of who you might have already hired or who you might be considering hiring to lead the charge in the online channel. And we often see two different profiles, the first of which is often an experienced CPG or FMCG leader, often who came up through disciplines like shopper marketing while those disciplines were still maturing, and have those people essentially learn e-commerce on the job. And the second model is to hire someone who's an e-commerce or a digital or a social native. That is, someone who maybe doesn't have CPG industry experience but has deep understanding of technology and e-commerce and have them learn CPG on the job. And I can tell you that both models can be successful. What I find is that it's often more successful, or at least lower friction, to take someone that knows the CPG business and is passionate about technology and have them learn e-commerce on the job by partnering with the right peer networks and outside advisors, as opposed to having somebody who knows technology try to learn CPG. And the reason is that, as I suggested at the beginning of this session, you really do need to build internal support and endorsement for your e-commerce efforts. And it can be challenging for those that don't understand the ins and outs of your organization or the CPG business to gain credibility inside of a big organization without some of that heritage. That's not to say it can't be done, but if you're on the line and you've got a history as someone who's managed commercial relationships or in trade marketing, shopper insights, and you're passionate about this space, I think you're a great candidate to build a career path in e-commerce, as long as you're a self-starter and eager to learn and partner where you may have gaps in your skill set. Once you've got an organization in place, you have someone who is overall responsible for the strategy and the direction of e-commerce, and ideally you've at least designated some folks on individual account teams to support the online channel, or at least have some shared team resources who can support some of the major work streams at both pure players and brick-and-mortar.com players. You'll quickly discover there is an abundance of solution providers and toolkits out there to help increase your performance. I'm going to briefly talk about product content, which I think is probably where you should start, because in the online channel, your product content is your digital packaging. It is what represents your brand at the digital shelf. And so when I refer to product content, I mean your product images, your titles, your descriptions, and many companies have some digital assets, maybe originally developed for physical packaging or print channels that they've tried to adapt to the digital channel, and that's not a bad start, but you really are going to want to focus on optimizing that content for the online channel. And that often means identifying agency partners who can help you develop that content, and there are some specialist agencies with deep expertise optimizing your content for the online channel. If you're interested in who those are, connect with me offline and I'm happy to introduce you. Once you've got that content, you're going to need to store it somewhere. So there are digital asset management or product information platforms to help you store it. And then you'll need to syndicate that content to each of your retailers. And so there are companies, some of which offer digital asset management and syndication capabilities, others of which are really focused on syndicating your content out to Amazon and Walmart.com and Target.com and so forth. And you sort of need at least these bottom two elements of the stack, and potentially all three, to really start to accelerate your performance. And then where we play is in the e-commerce data column here. And there are three data sets that I think are really worth considering, the first of which is shopper data. which we don't participate in, but shopper data is typically behavioral data, panels of either self-reported or even better, in my view, behavioral data that tells you what shoppers are actually doing in the channel, how they're arriving at your product pages at different retailers, and what's driving them to convert. You can get data like that from some of the big incumbent data providers, and there are some smaller specialist players that are worth understanding. And the second type of data is direct sales data, which surprisingly is really difficult to come by in the online channel. We're sort of where the industry was in the early 2000s when it was not possible to get point-of-sale data for all of, and certainly not even the largest brick-and-mortar retailer at that time. And in the online channel, you're likely only able to get intermittent data for your own product sales in the online channel. You may not be able to get a picture of the total category or where you sit versus competitors. And we do play in the direct sales data piece in the sense that for Amazon specifically, we can help you estimate the size of your category, the growth of your category, your brand share of the category, and things like the mix of first-party versus third-party sales at Amazon. We chose to focus on Amazon first because of its prominence in the landscape. And given Amazon's share of the total industry, if you can get Amazon right, it's a pretty good starting point. But we think over time, it's going to be essential to get more retailers on board sharing their data with suppliers, because a total market view is going to be essential as the channel matures to really helping the industry and helping suppliers make the necessary investments and optimize their investments. And then the third element is what we call digital shelf data, and that's another area that we focus on. And digital shelf data is something like the data that you might get from the brick-and-mortar retail environment. That is, we monitor what shoppers see when they visit online retail sites. So we can monitor the results on a search query. We monitor product detail pages and whether your titles and descriptions are accurate and complete, and things like ratings and reviews. And we think of this as an input into your performance. So these are things that you can actively impact when you have a better understanding of them. And I see a question coming in through chat.
Yep, I got too, Keith. Are you able to get this data on with ARA Basic, or do you require Amazon Premium ARA, or what else are you using to get Amazon data?
Yeah, it's a great question. So for Profitero's Amazon sales and share estimates, we really have two inputs that we use to build the data set that we share with our customers. We can work with either ARA Basic or ARA Premium. And for those that may be unfamiliar, all direct vendors to Amazon have access to ARA Basic, which is a free self-service supplier portal that gives you limited information about sales for your own products. And ARA Premium is for a fee service that gives you more historical data and some other premium metrics. We can work with either version. And then the second data set that we use is collected entirely independently from the digital shelf. So we actually monitor all of the products in your competitive universe at Amazon. And we have a patent-pending methodology for correlating some of the demand signals that we collect from the public domain with the actual sales data that we are credentialed to use from our customers. And using those two data sets together, we can estimate item-level sales for all of the products in your competitive universe. So you can see sales for individual products, both yours and your competitors, and then we aggregate that data up to the brand and the manufacturer level so that if you want to view the data for a competitive brand or a competitive manufacturer, you can do that too. So I don't want to go into too much more depth just to respect the time that we have, but I'm happy to go into more depth offline if that's helpful. So building on the importance of product content, certainly, and also a fact-based approach to managing your performance, we always think as you're beginning on your journey to outperformance in the online channel, we always conduct an initial assessment that looks at where you are and secondly looks at where your competitors are in the channel. And we help define some benchmarks. And you can certainly do this independently, but you sort of have to understand where you're starting from and where your destination is. And then we think it's essential to measure performance. And that means measuring both your digital shelf, which is the input. So are you executing as you should be? And then secondly, measuring your outputs or your performance, which is things like sales and share. And then through this virtuous cycle of defining targets, measuring performance, and tweaking your execution and your strategy, over time you can really accelerate your performance. And we focus our efforts, and we think you should focus your efforts on these points of leverage in the online channel. And so if you look to the right side of the screen, this is a really simplified view of the online path to purchase, but shoppers typically will arrive at your products either by searching for the product, either a generic search like laundry or a branded search like Tide, or they may browse the menu hierarchy. So you really want to focus on being discoverable through each pathway. And then secondly, they land on a category page or a search result page and ultimately a product detail page. And you really want to maximize your presentation on those pages so that you attract shoppers and convert them. If you've done your homework, they'll purchase, and then you have the opportunity, if you've got a great product, to activate those happy consumers and convert them into brand advocates through ratings and reviews. So I'll go into more detail here momentarily. So you will have to define some of your KPIs and your success metrics. And we think, this is maybe not a complete list, but it's a pretty good starting point. It's important to have some understanding of your sales and your share, particularly for a retailer like Amazon. You should be aiming for your fair share or greater, in our opinion. And then just building on my comments on the prior slide about these inputs and digital shelf metrics, you want to be monitoring your product content and auditing your content for compliance against the approved content that you've got in a digital asset management system. So do you have the right images, the right product titles, complete descriptions? Do your products have some minimum threshold of ratings and reviews? And are you able to respond promptly to negative ratings? Are you well positioned in search, and are you in stock? And I'll just briefly emphasize the importance of in-stock availability. Just as in brick and mortar retail, you can do everything else right that I've described. You can really optimize your search performance so that shoppers can find you. You can have great product content so that when they're looking at your product pages, they want to buy. But if you're not in stock, they simply can't buy. And so we find this is just a fundamentally critical thing to focus on. There was an FMI and GMA joint study earlier this year, that was not focused exclusively on the online channel, but did underscore that the first time a shopper encounters an out-of-stock product, they'll substitute a different product. The second and third time, they'll not only substitute the product or buy nothing, but they begin to switch outlets. And so it becomes an issue not only for the supplier, but then for the supplier and the retailer. And so one of the things we focus on is out-of-stock issues with some trend over time reporting and daily alerts. And if you're just getting started in the channel, I think while you should definitely focus on discoverability and product content, this is one of the first things to pay attention to, because if you're out of stock, no matter how good you execute in other ways, shoppers can't buy. I've emphasized discoverability and findability a few times, and I just want to set this up with a little more detail. But we find that while it varies by category and by business model, that is, it's a little different for Amazon.com, where search is the dominant pathway to individual products. At some retailers, the menu taxonomy is the dominant pathway. Overall, there's new data that says that 44% of shoppers start their searches with Amazon. So if you're trying to make progress, you really want to optimize your discoverability in search at Amazon. And that means first identifying what search terms you need to be placing well for. And you should be targeting 90% share of page 1 results for searches for your own brand, and perhaps 30% share of searches for generic category-related terms. So for example, if somebody searches for organic sausage, we think you should be targeting 30% or your estimated fair share of page 1 results for that term. And then you want to optimize your product titles and your descriptions to place favorably for those terms. So I don't want to suggest that we've cracked the code for the search algorithm at every online retailer, but we do have a pretty deep data-driven understanding of the factors that influence your position at different retailers. And in this column to the right are some of those factors, and one of the things we spend a lot of our energy on with our customers is helping you identify tweaks you can make to your product content to improve your position. Assuming you're findable, you certainly want to focus on your product content so that you attract shoppers from that search result page to your product page. And in that sense, you really want to focus heavily on your product title and your primary product image, because those are the two things that are visible on a category page or a search result page. And there's more detail than I have time to go into here. I think this slide is pretty self-explanatory, and you will have access to the presentation after today's session. But if you focus only on product titles and images, you can really significantly improve your search position and conversion. We've had customers improve conversion as much as 20%. Simply by making sure that their primary product image is a high-fidelity front of physical package shot so that it's clearly visible which pack size, which version or variant, flavor, and certainly which brand or sub-brand is for sale. And those kind of fundamentals can have a huge impact. As you work with retailers like Amazon that allow for multiple images, you want to start including images that show multiple angles. So it's optimal to show every side of the physical package if you can, especially nutritional information, really clearly legible. Essentially you want to answer every question that the physical package answers. And then because you've got more digital real estate, you want to offer a complete and compelling description. And so that's your opportunity to introduce more romance copy and potentially include things like product comparison matrices, so that if you have a regimented product or a portfolio with different value tiers, you can educate the shopper and help them make decisions about which version might be best for them. Just briefly, I mentioned ratings and reviews a few times. I really can't emphasize enough how important ratings and reviews are. In the left column here are just a handful of studies that really give you insight into how influential these are, not only for online purchases, but also offline purchases. And you should be focused on a handful of objectives. One, you want to set a target for a minimum number of reviews. And you may be wondering how you can impact that, but retailers like Amazon as well as third parties have programs that you can invest in to distribute samples to panels of high-volume reviewers who will leave an authentic and genuine review of your product after receiving a free sample. So it's not always cheap, but it is possible, especially for blockbuster SKUs or new products, to distribute some samples and essentially seed some reviews on some of the more prominent online retail sites. And I can't emphasize enough the importance of authenticity. Do not have your staff go write fake reviews. There are penalties for that, not only formal penalties, but there are more and more tools that shoppers can use to suss out when reviews are inauthentic. So please don't fake it. And then if you do find yourself discovering poorly rated reviews, one, you should respond to those because more and more retailers allow you to respond from a credentialed account. And it's a great opportunity to showcase your responsiveness. And you can also work with someone like us to analyze the text of those reviews as another source of consumer and shopper insight. So we don't think this will ever be a substitute for focus groups or panels, but there's a wealth of insight that's sitting dormant on these product pages in the form of reviews. And it's possible through natural language processing and semantic analysis to unpack whether the issue is with the product or the packaging or the shopping experience. And it can be a really low-cost, efficient way to get insight from people who have already had an experience buying and using your product. Here's a little bit more detail on our approach to measuring sales and share. Given the time we have left, I'm not going to dwell here, but as I said earlier, if you have questions about our methodology or some of the questions that are answered, don't hesitate to connect with me offline. And I just want to wrap up, and we may have a minute or two for questions by saying, as you get started on this journey, I think you should plan to spend half or more of your time building internal alignment and support, especially if you are designated responsible for leading the charge in e-commerce. You'll definitely spend a lot of time working directly with Amazon and other online retailers, but given the complexity, you'll have to really influence your peers. And so just don't be surprised when you spend a lot of time building the case internally. I find it's very helpful as you're doing that. While there's a lot about the online channel that is distinct from brick and mortar, wherever you can translate familiar concepts from brick and mortar retail, both specific key performance indicators and even just the vocabulary, I think that's important. So if you're talking about the importance of search in the online channel, you might compare it to the importance of aisle placement in brick and mortar. It's important in a physical store to be at eye level and focus on things like brand blocking. And at the digital shelf, findability is all about optimizing your position in search. So think of ways you can use familiar concepts and terms to explain how to optimize performance in this channel. I think in the near term, while volume is building and the growth is compounding, you may want to emphasize the risk of doing nothing. And you can use some of our Amazon Fast Mover reports just to highlight the incredible growth of some emerging brands that may not be on your competitive radar. And if you just project out the impact of some of those new players continuing to outpace growth as this channel grows from around 1.5% of all CPG to 5 or 10% of CPG, the downside risk of failing to take action may be as motivational as the upside potential of investing. Don't feel like you're alone in this. You can build a network of peers at non-competitive CPG companies and other well-placed folks in the industry. I spend a lot of my time with both customers and non-customers. just helping them plot a course and react to some of the evolving dynamics. And then I think, once you've got support, you have to measure what you intend to manage and have a commitment to continuous improvement. None of this happens overnight, but if you have clear targets and performance metrics and you're continuously optimizing the way you execute in the channel, I think you'll continuously improve. So just to conclude, I think all commerce is digital, and everyone on the line, whether your title includes e-commerce or digital, I think you'll be impacted by the growth of this channel. And so whether you have to really focus here or simply be informed, I think it's becoming non-negotiable to have a baseline understanding. As I said in the discussion around working with Amazon versus others, not all online retailers are partner-oriented. And so understand the distinctions between partnering with brick-and-mortar.coms versus a platform like Amazon, and understand that the playbook that worked in brick-and-mortar may not work with some of these online pure players. Measure and execute, and I think you can really represent your brands well and outperform. So appreciate everybody joining us. I know you've got a great day, and I want to keep us on schedule. I'll flip it back to John to see if there are any other questions.
Sure, we do have a couple.
Thank you all for joining us.
Yeah, okay, thank you, Keith. We do have a couple of quick questions here for you. Number one, where should e-commerce report in an organization?
Great question, and not to deflect it, but the answer really depends on a few factors, not least among them your organization's culture. So I've looked across the industry and found that in about 3/4 of companies, e-commerce reports into the commercial organization, into sales. And I think if your objective is really on building volume in the channel, then that probably supports that objective. But I think when you look at data in support of the influence that the channel has, the disproportionate number of searches that start on Amazon and the influence the digital shelf has over offline retail, I see a growing number of manufacturers having e-commerce reported in the marketing. And in fact, there are a lot of approaches and marketing tactics that I think have a lot of affinity and alignment with the online channel. So the reality is there's no right answer for every company. I think it depends on your objectives corporately, and secondly, your culture.
Okay, another question, Keith. Which CPGs are leading the industry in e-commerce?
It's a good question. I would tell you that, well, I'm not going to name names. I think there are probably a half dozen companies that have made very strategic investments in e-commerce going back, 4 or 5 years. And I've been working with 20 or so CPGs in the e-commerce space for the better part of a decade. And what they got right was they invested confidently ahead of demand, and they understood that being well positioned in the e-commerce channel, as in other emerging channels, is a long-term strategy and pays dividends as the channel matures, not overnight. I also think that while some of the brands that you hear the most about, particularly in the mainstream press, they're doing a lot, they may not necessarily be the most successful performance-wise. And that's not to diminish the importance of trade relations and being visible from a public relations perspective. But I would say that there are, differing approaches, and while it can be helpful to be really visible in the industry, I think that the bigger opportunity is following a playbook similar to what I've outlined today, which is first, gaining widespread internal support. Secondly, establishing an e-commerce organization, having clearly defined strategies and objectives, and then continuously measuring and improving performance. And I think there are a growing number of CPG companies that have followed that pathway, and they're not hard to find. I don't want to name names, but hopefully that's enough to go on.
Okay, thank you, Keith. If anyone else has a question, you can email Keith Anderson directly at keith@profitero.com.